Welcome. My name is Chris Gosling from Australian Fund Monitors. Today we're talking to two really experienced fund managers, Robert Swift from Delft Partners and Alex Pollock from Loftus Peak. We're going to be talking about what is going to happen or what they expect to happen beyond the end of the lockdown. What's going to happen in the long term, forgetting the noise and the bustle of today's volatility and the volatility of the last month or two. Robert, can you give us a view on where you see things are going from here, not necessarily in the short term, but possibly also in the longer term?
Yes, thanks for having us on, Chris. Hello, Alex. The short term, we think is very difficult to forecast. The companies themselves don't know what their earnings are like, and many companies are pulling earnings guidance as well as actually pulling dividends. So the near term is very difficult indeed. And what we've decided to do at Delft is just to think about some of the headwinds that are going to develop and some of the tailwinds that might develop as a result of changes in government attitudes towards companies and the economy, and companies' attitudes towards how they distribute profits versus wages and how they deal with government interference. And then what are individuals going to be doing as well? This has been quite a shock to people, particularly those who've gone to short time or lost their jobs. And it's pretty clear that people's behaviour won't go back to quite what it used to be. So we've sort of thought about the long term in terms of the three segments of government intervention, company intervention and what they're going to be doing with respect to their strategies, and also how are individuals going to change not just what they spend their money on, but how they save. This has been another big shock in most people's investing lifetimes following the 2008-2009 GFC. And yet again, people have been caught holding stuff that is politely called junk. And I think that people are going to have to think hard about how they plan for a retirement in a world where official interest rates are close to nothing. And that's going to be, I think, a challenge for the next few years.
So you see this as a game changer we talk to a lot of managers and they say, oh, this is all going to be over in 3 months or 6 months and then everything will get back to normal. What you're saying is, and I think I probably agree with you, that there's going to be a new normal and it's going to be very different from what we've known in the past.
Yeah, please feel free to chime in here, Alex. I think it's a brave investor who says this time it's different and we need to sort of completely change the direction of the ship, and we don't believe that things that have happened in the past are going to happen in the future. We're not arguing really that we're not going to see a return to a mixed economy where the government and capital gets involved together. I think that the margin, we're going to see a shift in the following ways. One is that companies are going to be much more under the spotlight than they were. So the profit versus wages share has never been more in favour of profit over wages. And so that the S in ESG is going to come up for grabs. I think a number of companies are cleverly managing zero tax, corporate tax. And I think that's going to be seen as a very antisocial thing to be doing when people are going to be yelling for more healthcare. And I think also that companies are going into this not just with an operating leverage, but they've gone into this with financial leverage. And so things like buybacks, which have helped executive share option schemes, but not really prepared the company for a difficult, adverse environment such as this, those are going to be under increasing scrutiny as well. So we see governments getting more involved at the regulatory level regarding dividend payments, equity stakes in exchange for bailouts, etc. So we do think there's a number of significant changes coming. And that, on margin, will mean returns are going to be nearer 6 to 8% from equities, as opposed to the 12 to 15% that we'd all like to see in perpetuity. So we're thinking things might be more stable and more harmonious, but returns are coming down.
Alex, can we just cut to you for a second? I mean, the Global Disruption Fund that you run has looked at and does look at what's coming in the future more so than short-term earnings. Can you just maybe elaborate on that?
Thanks, Chris. So we are now in the middle of the largest living and working from home experiment that has ever been run on the globe. I guess it's hard to know exactly what's going on. We have been thinking about this for a while, even before the COVID thing, because we've been very focused on this shift from real assets to digital assets. And if you just look at all the different ways that that's playing out, you can see that the move to the online world, the digital world, is really has been gathering pace for a long time, and COVID is actually pushing it further and quicker in that direction. So thinking about just a local bank like NAB, it's replatforming all its call centres to run on Amazon Web Services, so the AWS cloud. Telehealth, which is, people visiting doctors and getting health generally, is moving into the tele space, by which I mean telehealth. Visiting your doctor online is now a rebatable item. You don't have to go to the surgery. You can do it literally over the phone. Obviously, the whole, don't go to the shopping centre, get your groceries and goods delivered direct to your door. That's been going on for years through Amazon and is continuing to do so. Banking itself, we talked about the NAB platform, but banking itself is already fundamentally a digital product. And you can only expect that, that will go further along those lines in the next couple of years as banks kind of reposition themselves, fewer branches, etc. And we've already heard instances of continued or increased focus with respect to, using the app on your phone for digital banking. So, and then of course there's Netflix and without the sport, Foxtel becomes increasingly sort of, an expensive product without great content on it. And so, that's another example of kind of the movement away from the physical into kind of these over-the-top platforms.
So if we can look at that from a global perspective, do you see certain regions? I mean, you obviously see certain sectors benefiting from this. Do you see certain regions benefiting from this, Robert?
We've been very constructive on Japan and Asia for a little while. We think that Japan as an economy is actually badly analysed and is somewhat misunderstood. Japan's economic growth is not due to a lack of productivity and workforce skills. It's primarily due to demographics. If you adjust for demographics, Japan has outperformed Germany and the USA. And what for us a few years back looked very interesting about Japan was that it not only had a pretty harmonious society where the balance between profits and wages were pretty good, but companies were beginning to take shareholders more seriously. If you like to think about Japan in terms of the pendulum between wages and profits, it was too much in favour of wages and not enough in favour of shareholders. The USA was the opposite. The USA was all about shareholders and not so much about the wages. And so Japan looks to us as a business model to be both technologically advanced, to speak to Alex's digitalization work, with which we agree, but it also appears to have got the right balance between financial leverage and operational leverage. Japanese companies have got about 6 trillion yen on their balance sheets, which is way more than the Japanese budget deficit, by the way. So Japanese companies are not looking at having to go and get emergency bailout funding from the government. Japanese companies have run much more, conservative balance sheets. And so dividends from Japanese companies are surprisingly quite good at this stage because the shares have been neglected for so long and the dividends have risen. So we like Japan and we like the USA just because it remains one of the most innovative places, aggressive places for new ideas on the planet. The place that we struggle to find ideas in is Europe, which is politically dysfunctional at a time when they need to be politically unified to deal with not just COVID-19, but also the problems arising in the peripheral countries in the south, where the banking system is ultimately going to take the strain for a lot of very clear fiscal and productivity differences between north and south. So European companies are not just lacking in technological innovation, but the political dysfunctionality means that the banking system is going to be front and center of any nasty crash that is likely to come about. So we've got half our money in Japan and Asia and, balances in the USA and almost nothing at all in Europe, which is a pretty aggressive stance. But that's held up pretty well for us so far anyway.
Alex, from the point of view of Loftus Peak, are you still very much focused on the USA, or are you diversifying out of that? Are you comfortable with that?
So all of the companies in which we invest have global businesses. They might have a listing in the United States, but they're all global businesses. And so they are leveraged to the global economy, so to speak. But to pick up on Robert's point about the undergeared nature of Japanese companies, that is an excellent point. And it's true of Japanese companies. It's also true of the companies in which we invest. One of the things that we see that is happening as a result of all this is that companies which may have needed issues, either debt or equity issues in the next 12 or 18 months, may struggle to get those issues away to the benefit of those companies that have cash on balance sheet and robust business models that are already proven. And so, in a sense, it's going to, the well-financed companies, the companies that have got low debt, like some of the Japanese companies, but also robust business models, are the companies that are currently doing the best. And we definitely see that trend continuing. And to your question, Chris, it's not just a question about, companies being US focused. The technology may come out of the US or the business model may come out of the US, but what is the business model is being rolled out to global customers. And we very much believe that is the way it's going to continue to work and inform the better performing companies.
The area or the geographic area and political area we haven't discussed, which we might go into, is China. I mean, this started in China. There has since been a focus on Europe, and there's now a focus on the US. Do you see any sort of long-term trends coming out of this pertaining to China?
Chris, China, because of the modernisation that was going on, needed to skip the 20th century and go straight to the 21st century, by which I mean it was primarily a rural agrarian economy. They modernised to some degree into the 20th century with, buildings and office blocks and retail centres, etc. But again, going on this earlier comment about the shift to digitalisation, their best companies, Alibaba and Tencent and Baidu to some degree as well, have shifted straight into the digital world, again, away from the real world, real inverted commas, into the digital world. And those companies are continuing to outperform, which is the continuation of the trend. So that we saw, with them 10 years ago. So China, where we are positioned in China was correct before COVID. China has got through COVID, or at least it appears to have for the time being, and it's still going hell for leather on this digitisation process, and the companies we invest in are very strong on that process.
You mentioned the real world being the old world, but perhaps the reality is, excuse the pun, the real world is the future world, the one that you're both talking about in many ways.
Yes, that's very much the case, Chris. As we said, it started years ago with, the movement of books and movies, etc., onto online platforms, and has continued through into the physical world. And now we see, people questioning the value of retail malls, and never more so than with the COVID that's going on right now. That also plays into, we just read a piece this morning that said that Netflix is being offered a whole lot of movies which previously were going to premiere in cinemas in the next few months, but now they can't offer those movies in cinemas anymore, so Netflix is being offered the rights for them. So the whole kind of world is shifting away from these real assets onto into this online world, and I think that's just going to continue.
I think that's very true, and if I can just make the comment, even now, we're using Zoom. Zoom is an everyday household word now that 6 months ago hardly anyone knew about. Certain people did in the business area. So that's one way I think that businesses are going to change. But we've also got the situation with travel. I think travel is going to be restricted for some considerable time. Airline travel, the airline business, I think companies are going to change the way they do business, the way they manage their businesses. Robert, can you see that happening more or less in a certain area?
I think that the big ticket items, the big consumer cyclical companies, absolutely are going to have to think very hard about their business models. The operational financial leverage together is a real problem for them. All the airlines in the US, I think, have been buying back their own stock. Well, that probably means a bailout, and that bailout is going to come at the expense of existing equity holders. And so it should. I think that the taxpayer got slugged when the banks were bailed out in 2009 without really any recompense to the taxpayer. But in terms of things that they're going to have to be wary of, I think that they're going to have to be wary of increased government intervention. So Donald Trump was very quick to blame China for tech theft. He's not alone in this. There is a sort of a four-country unified attempt with Japan and Europe and the USA to stop the tech theft from China. And companies like Qualcomm and Micron export 40% of their stuff to China, so it's not clear that companies that can go global will be able to go global. But in that sense, the world may be shrinking, and China knows this, so it's spending a lot of money on developing its own tech industry, which is not yet an investment opportunity. But nonetheless, that's a risk to, I think, global companies. And the second one, I think, is just going to be this ability now to intervene in companies, not morally, but legally. So Donald Trump has invoked the Defense Production Act from 1950, which has forced 3M to think about whether it can actually send its Singapore-based face mask production into Asia, or whether it has a legal obligation to send it back to the USA. So when you get governments involved in multinational enterprises like this, it's not always the best return on capital and not always the most productive. So again, we think the world may be not going global quite as quickly as it otherwise would have been. This is not, when COVID-19 is gone, this is not going to go away. I think particularly in the election year, it's going to be very tempting to blame China for this flu, to blame China for its undue influence on the WHO, and then to really look to put the boot into China and maybe emulate some of China's state involvement in corporations. That's a serious risk, I think, to multinational companies. And we invest in the multinationals as well. So we're quite mindful of this regulatory risk, actually. It's going to be a concern with which we have to watch, the companies we choose.
So the move to global free trade that has been underway for some considerable time is potentially at risk?
Well, I think trade will still continue, but it's going to be much more heavily supervised. I think also people as consumers are going to be much more wary of both how they travel and where they travel, but also provenance of things like food. So you're beginning to see in Australia food companies get very, very high PE multiples because we know the Australian food chain has not been completely polluted. Well, if you've got people coming out of China who've been to wet markets that haven't been ever certified as being clean and hygienic, governments might not wish for free movement of people to be quite so free in the future. People are going to think again about, do I buy this stuff from this shop that's not got provenance of food quality? So I think the food chains and the global supply chains will have to be more robust, but will probably become much more heavily supervised, which is another way of saying less lean and efficient.
Gentlemen, many thanks indeed. We've covered the macro. Just to wrap up, what we might do is just ask each of you for a couple of the company examples that you particularly like at the current time.
Well, we do continue to like some of the obvious ones, Alibaba and Tencent out of China. We are very focused on this move to the cloud. And again, that's part of the digital real estate. So companies like NVIDIA as beneficiaries, we think are very important. Xilinx is another one, which is very important in what we call the cloudification, the move to data centers as a mechanism to deal with very large online communities of people, whether they're Zooming or watching Netflix or ordering something on Amazon. The cloud is a critical part of that. And so Xilinx, NVIDIA, very important. Microsoft, because of Azure, the cloud business, they have very important. Alibaba and Tencent in China, again, their cloud business is incredibly important. So we are playing the digital infrastructure to some, I think is one way to call it, which undergirds the 21st century. And that is very much what is showing up in the revenue of the companies that we hold, and it's kind of behind the good performance we've had. So those things and of course obvious things as well, like Netflix, which is also a beneficiary. The disbeneficiary, the traditional cable companies like Comcast in the US, or indeed even Telstra in Australia. As you say, we're doing this on a Zoom call. It may have been over a Telstra wire or an NBN wire at some point, but the majority of the revenue is accreting, and the majority of the value of the transaction is accreting to the Zooms of this world, rather than the broadband, dumb pipe service provider. So that's part of all that.
So Alex, just on a fund basis, it's fair to say that you actually haven't changed your strategy at all, and you probably haven't changed your portfolio composition very much.
We're not doing anything different in the portfolio than what we've been doing actually since the 6 years that we've started. It's just that COVID has accelerated this shift out of what we think of as real assets into digital assets. But it was very much something that was already in trade. Banking has moved to applications on your phone. The back end of telephone companies is increasingly being run on Amazon clouds and Microsoft clouds. So it's no longer this idea of switches, of phones and switches that are making telephony and over-the-top services on phone networks work. It's all about what happens in the cloud as the connecting infrastructure between consumers or businesses.
Rob, can I just ask you the same question? Any particular companies or sectors that you like?
Well, as I said, we like Japan and we like the USA. We've come to the same conclusion as Alex, and we own different stocks, but benefiting to some extent from the same tailwinds. We do own a so-called dumb pipes provider, but we think that they were dumb and they're becoming less dumb, and that's Verizon, which, following the end of net neutrality in the USA, means that the owner of the 5G network, which Verizon is building out much more rapidly than the other telecom companies, it means that they actually will be less dumb in the future, and they're a pretty conservative company on a conservative rating. We kind of like the cheapness and change concept there. In terms of all of this cloudification, as Alex describes it, someone's got to build the bits. I mean, there's the software piece, which is Zoom, but someone's got to build the bits, and you've got to test the bits. And there's rapid change there coming forever and ever, lower and lower bandwidths on processing and the semiconductor chips. And we've got a company called KLA-Tencor in the USA, which is the world's dominant provider of metrology or testing equipment. Once you build this stuff, you need to make sure that the fabrication is done precisely, that the mounting of the chips works precisely. And KLA-Tencor does all this and is a global leader. And again, it's on a fraction of the multiple of these so-called go-go sexy stocks. And we quite like that company as well. Its big rival, Hitachi High-Tech, was one we used to own, and we sold that last year as it got absorbed by its parent company, Hitachi. And then in Asia, we like the idea of Asia pouring more concrete. Its capital infrastructure, particularly in China, is probably still where we were in the 1960s. And this is a chance for China to use its investment dollars. It's got a very, very good balance sheet, sovereign balance sheet. And we think they're going to be spending quite a bit of money on improving physical infrastructure. And so like a company in the smaller space called China Lasso, which makes very unglamorous plastic PVC pipes, but they're used in every single major, urban center in China to build out sewage in the telecoms network. So, you don't have to pay up a lot of money to benefit from this cloudification, digitization, and expansion of the Asian economies, because the physical stuff also has to be put in place as well. Like Alex, we haven't made a lot of name changes to the portfolio. We like to think that hanging out there for a 2 or 3, 4 year holding period is where you tend to make most of your money as investors realize what you've found out.
Gentlemen, this has been a fascinating discussion. I'd like to continue it for a lot longer, but we do have time constraints, and thank you for your time. It's really good to talk to experienced fund managers who are looking beyond the short-term gyrations or rises, falls and volatility of the market on a day-by-day or week-by-week basis, and actually are looking towards the future. We'll look forward to speaking to you again. Thank you for your time today.